Hi everyone. Now we are going to begin on Chapter 6, which is about special journals. So if you could open your textbook to page 78, and in your working papers, please pull out 4 sheets. They should be somewhere in the middle of your working papers. You might have to dig through, but you will find them. One is Purchase Journal worksheet. Then Sales Journal worksheet. And the Cash Receipts worksheet. And the Cash Payments Journal worksheet. Let's talk about these. So far in our course, we've covered a lot of the basics of bookkeeping. We've talked about accounts. So let's recap. We have 5 classes of accounts. What are they? Assets, liabilities, equity, revenue, and expenses. Within those classes, they function differently. So we have our balance sheet accounts, which tell us what the company owns and what the company owes. So that is our assets, liabilities, and equity. Our assets, liabilities, and equity are the accounting equation when we see assets equals liabilities plus equity. That's the accounting equation. So we have the assets of the company, so everything the company owns, regardless of how it's financed. And then when we look at our liabilities and equity, that's all about how it's financed. So the liabilities is everything, it's the proportion of value of the assets that is financed externally. So by suppliers, the government, loans, a credit card company, however it's financed. But it's not financed within the company, it's financed externally. And then our equity, that talks about how much of the assets within a company are financed internally. So by the revenue of the company or the capital that an owner has put in themselves. So the two together, the financing from external sources and the financing from internal sources, together that value is the total value of the assets. So we have the value of assets of what the company owns, the value of the value of liabilities and equity of how what it owns is financed. So what it owes. So if the company were to liquidate, if it were to go bankrupt, if it were to get sold, however you want to liquidate it, if it were to liquidate, the amount of liquidated assets, so the amount of cash that the owners could walk away with, should be equivalent to what the equity amount is on the books, because that is the amount of the assets that are financed by the company. Therefore, that is what the owners own. And that's what they could walk away with, because they have to pay all the liabilities first. Liabilities, especially the government, they need to be paid first. And employees, if you have wages payable, the government will not let you walk away from a company and not pay the employees. It has to be done. So those liabilities need to get paid first, and whatever's left over, that goes to the shareholders, and they can walk away with the equity. Now, the income statement accounts, that's our assets that's our revenue and expenses. Those are our income statement amounts. So we have all of the sales of a company and all of the expenses of a company. The difference between your sales and your expenses are the profit or loss of a company. So that bottom line, so revenue minus expenses, the bottom line, that actually appears on computerized bookkeeping reports as a current earnings. So the income statement accounts, the revenue and expense, that when you combine them, that number, that value of the revenue minus expenses, that is actually a value within the equity. Does that make sense? So in your trial balance, you're not going to put that number. You don't put a bottom line number in equity, because on a trial balance, you have all 5 accounts. So you have your assets, your liabilities, your equity, your revenue, and your expenses on a trial balance. However, what I'd like you to think about is that the revenue and the expenses are simply an extension of the equity. They're part of equity because it's what's coming into the company, what's going out of the company, and the difference in value, if the company is receiving more cash than what they're spending. So if more value is going out the door to customers than the things they're buying and expenses coming in. So if their revenue is exceeding their expenses, then they're in a profit position. Make sense so far? All right. So we have talked about five classes of accounts: assets, liabilities, equity, revenue, and expenses. So say that after me, or say it with me. The 5 classes of accounts are assets, liabilities, equity, revenue, and expense. The 2 main financial statements that you will go over as a bookkeeper with your clients in order for your clients to have a grasp of what's happening financially in their company are the balance sheet and the income statement. The balance sheet is a snapshot in time. The income statement is a report on the comings and goings of revenue and expense over a period of time, whether that be a week, a month, a quarter, whatever the reporting period might be. And so the classes of accounts that appear on a balance sheet are assets, liabilities, and equity. And the classes of accounts that appear on an income statement are revenue and expense. So then we have the 2 financial statements, balance sheet and income statement. And we have the 5 classes of accounts, assets, liabilities, equity, revenue, and expenses, that fall onto those 2 reports. Now, how do we get the numbers onto those 2 reports? Well, we do it by our bookkeeping. So we have gone over our journal entries. So up till now, we have used the general journal. So in the general journal, we have our debit accounts first, then our credit accounts. We have a comment line. We make sure our transactions balance within the general journal. And that means that our debits have to equal our credits. And we record it there. After we've recorded a set of transactions, then we post them to the general ledger, which means we take each line of the general journal, each line that has an account and an amount, and we post it. So we record it into the general ledger, which is a record of each account. And for each account, then we can see the transactions that occur ongoing. So a general ledger is kept over the fiscal year. It is not a book that ends each month and restarts. It is an ongoing record throughout the fiscal year of a company. So we have a general ledger that the general journal gets posted to line by line. So far, so good. And then we are taking, at whatever point in time that we're concluding our posting of from the journal to the ledger. So if we're doing the books for January, then we would make sure that all our transactions are recorded for January. We would make sure that all of them are posted line by line from the general journal into the general ledger. And once all of them are posted and we know they're all posted, then we take that running balance in the general ledger, and we know that shows whether it's a debit or a credit balance, and we transition those figures into our trial balance. And our trial balance then is just one number for every account. And every account meaning asset, liability, equity, revenue, and expense, every single account within our bookkeeping system. And then once we have those numbers on there, remembering that we have our debit column on the left and our credit column on the right, then we can add all of the debit column amounts and put their total at the bottom of our trial balance in the debit column. And we add all of our credit balance amounts. And remember, then it appears as the total of our credit column. And those numbers need to equal each other. If they don't equal each other, we've made a mistake somewhere. Now we can make a mistake somewhere and it not be, and our trial balance could still equal. Because if we, for example, post an amount to the wrong account, then it will still have the same amount. It'll just show up under the wrong category. So it's not the only point to check. The trial balance figures being equal is not the only thing to check to make sure that you've done your job correctly, but it's a good starting point because right off the bat, if your numbers don't match, then you've got a problem. What would be the first thing you check? Well, the first thing I check is my own adding. If I'm using a calculator, let's just say we're using a calculator like this, then there's a good chance that we've messed up a number somewhere along the adding process. So then I'd re-add. Most of the time as bookkeepers, you'll be using an adding machine, which will have a tape, and a tape of the record of what you've input. Well, that's a lot easier to double check because you can just pull out your tape and you can just lay it down right on top of your trial balance and check, did I get a number wrong? And then you can find if you made an adding error. And there are different, in our chapter on correcting errors, we talked about different things that you can check, the dividing by 9 rule and different things, a sliding error. So there's different things you can check. We talked about how important it is to use your decimal. Make sure that you put the full number, including the cents, meaning the number to the 2 decimal places, in all of your transactions. Why? Because it's too easy to make a sliding error if you're not consistent with your formatting. So now we're going into chapter 6 about special journals. And in special journals, what we're doing is we are taking the functions of sales. So remember, sales has to do with revenue. Sales is any product or service that the company sells. Any product or service that goes out the door. So that product or service is a credit because it's leaving the company. The customer is paying money to the company, so it's a debit to the company. The cash is a debit to company. The product or service leaving is the revenue, that's a credit to the company. Unless it's sold on account, in which case the product or service that's leaving the company is a credit. And then the debit to the company is an accounts receivable. The customer's account with the company because the company has said, hey, I trust you, I've checked your credit, and you can buy this amount of our products or services without having to pay cash immediately, and so it's sold on account. So we can do a debit to an accounts receivable account and a credit to sales and taxes. Or we can do a debit to cash or the bank and a credit to product, services, and taxes. So that's our sales. So for that function, we actually have journals that are special for the sales function. And that is our sales journal and our cash receipts journal. So our sales journal is where we're going to record all of our sales, and you can see that there's accounts receivable column, and then there's columns along the side. So we're going to talk about how to use this as we go through this chapter. Our cash receipts journal is our cash receipts. So when a company, when the business we're doing books for sells to customers on account, and those customers then come back and they pay on account, well, then we are going to have this cash receipts journal where we can receive the cash that they pay on their account. We can record the payments made on that account. So sales journals, cash receipts journals, all the special journals, what they do as far as our bookkeeping and our posting to the general ledger and the entire process is they actually simplify it because it eliminates the need to post every single line to the general ledger. So what happens is, say you have 20 transactions, you're not going to post 20 different ones for every single account that's touched, because for example, for your sales, you might have your sales, whatever, wallpaper sales for your project, and you're going to have 20 different times when that wallpaper was sold, and then you'll have a total at the bottom. So at the end of the month, instead of posting 20 different transactions to wallpaper sales in the general ledger, you're going to add up your special journal and you'll have a total at the bottom, and that total is what gets posted to the general ledger. So it saves you quite a bit of the back and forth steps between the journal and ledger. So instead of having one general journal that captures every single transaction, the special journals take the functions of the regular occurring types of transactions and puts it on one journal. Now, why would we do that? Well, there's a number of reasons. Let's take our sales journal, for example. Now, most of the time, if you go into a store and you purchase something, have you ever seen someone pull out a binder and they're like, wait a second, I'm going to write this product item number down. Wait, no, I know there's 10 people in line behind you, but I need to write the next one. And they carefully write every single one. And then 15 minutes later, they let the next customer in because they've recorded all your stuff. No, they don't do that, because we have technology these days that allows so much of that to be done automatically. The most common way that you are going to see when you go to a store, whether it's the grocery store, whether it's a gift shop, no matter where you go, you're going to encounter a point of sale system most of the time. So a point of sale system could be as simple as a cash register, and even cash registers where you are manually typing in the keys with the amounts will generate a report. It might be a tape that prints at the end of the day, and at the end of the day it says, okay, well, this is the number of Pepsi Cola bottles that were 591 milliliters that were sold. Or it might say all the pop, it might say beverages sold 987.21 of beverages, and it'll show the taxes. GST received $136. Whatever the number might be, the point of sale system actually accomplishes what our sales journal accomplishes. Okay, so our point of sale system, the ones you see whenever you go into a store and whenever you are buying something as a consumer, you're interacting with a company that's using a point of sale system. Now, a point of sale system is based on the idea of a sales journal, because what it allows is it allows the company to have a staff member that's their job. Their job is to produce those sales. Their job is to facilitate the transactions of selling the company's products or services. And when they do that and they push their buttons and they receive their cash and they enter what they need into the point of sale system, that is them recording in the sales journal. They don't even know they're doing it. But that's what it's based on. It's based on the sales journal. So when we go through these exercises, what you are learning is the process that's behind the scenes of all these electronic technologies. And it's important as bookkeepers that you learn this and you understand this process. It's not enough to just push a button and push enter and be told, well, you don't need to understand what it's doing because the computer does it for you. Well, what if the computer messes up? What if the computer breaks down? What if the computer spits out information that's a little mixed up and you need someone who understands what is going on behind the scenes to sort it out? That's what bookkeepers do. We take that information and we put it into the books. And so we need to understand what's happening behind the scenes so that when we receive the reports that are generated, we know what we're looking for. We know what happened. We understand that the sales of the company were credits, transactions of products or services leaving, and that the money received was debits to the bank or to cash, that the sales taxes received are credits to the liabilities, not to sales, because it's not money that the company gets to keep, etc. So we understand those. So we need to learn. That's why we're learning these concepts. And that's why we're learning things like the special journals that have a specific function. Because in real life, in real companies, often there is one person at the till at a time. And that's their job. So now let's look at, we're just doing an overview of these concepts. So now let's look at the purchase journal. So in a purchase journal, think of a company, any company that has an office or a receptionist. an office administrator, an office manager. How have you ever had a check written to you from a certain company for whatever? Might be that you're a project manager for Ramada Hotels and such a company has rented a room from you to cater an event, and so the such a company writes you a check. Well, that person from such a company that wrote the check is a staff member. Now, it might be a bookkeeper who wrote the check. Often it's an office manager. Often it's someone in an administrative support position. They don't necessarily have signing authority to sign the checks, but they produce the checks. And that's their job. Their job is to administrate all the expenses going in and out of the company they work for. But they're not at the till. They're not making sales. They're just doing the purchases. Those people do a lot. So I'm not trying to simplify that. I'm just stating that lots of times the jobs that people have within a company have a specialized role. And the accounting functions, the daily accounting functions, are often done by people on the ground in those companies, not by bookkeepers or not by accountants, but by entry-level positions who their job is data entry, or upper-level administrative positions whose job is to coordinate all the accounts payable, and it's their job to determine which of the purchase invoices get paid first. Some of them, maybe they have a policy of paying them right away, and some of them they have a policy of waiting 20 days or waiting 40 days or whatever, and it might be a policy based on the companies. They might have a list saying with this company, we'll pay within 10 days, and this one 15, and this 30, and this 45. And so you might have a administrator whose job is to track that, and then they need to make the decisions of payments. And so the function of the purchase journal is to track the invoices that come in, the purchase invoices. So when I'm doing the books for KBC company, and KBC needs to buy wallpaper merchandise. They need to buy that in order for resale, so it's the wallpaper expense of the company. They receive an invoice from their supplier for that wallpaper expense. So that's a purchase invoice. It gets recorded in the purchase journal, and the name of the supplier gets recorded, and the terms get recorded, etc. And then we have our cash payments journal that tracks when we're paying that account off. So when we have an accounts payable, then that means we're going to purchase things on accounts and we're not paying for it immediately. And then at a later date, we are going to pay it, and then we track. We track when we write those checks. We track how much. We track where the balance of those accounts are. Now, the tracking of where the balance of our supplier accounts are, that's done through the general ledger. And the tracking of where our accounts receivable for the customer side is, that's done through the general ledger as well. Those are sub-ledger accounts, and we'll be talking about those as well. So open your book to the page 78 and using special journals. Now we're going to cover this chapter. It's the biggest chapter of Book 101. It's the most complex, and we will be going over it over the next week and a half. So you're not going to have this completed by Sunday night, but you will need to have quite a bit done by Sunday night. So start off by reading the 29 pages from page 78 to page 108, or I guess that's not 29, that's 31. So 78 to 108, read it carefully. Just read. Before you do anything, just read. And after you've read through the 31 pages from front to back, then go back to the beginning and reread about the sales journal. So that's pages 78. Let's see, before we hit the purchase journal. Sales journal goes all the way quite a ways, to page 94. So page 78 to 94 is all about the sales journal. So you're going to read that. And my next video will touch a little bit more specifically on an exercise in the sales journal. So before you watch the next video though, read the chapter and then reread the sales journal section, then come back for the next video.